Hi everyone. In this video, we are going to answer a very important question. Are you doing SIPs in the right stocks? We will explore how to identify high quality stocks that are suitable for long-term investing. So if you are a retail investor planning to build wealth over time, stay tuned. A quick overview of what's coming up in this video. This isn't about mutual funds. It's about how to use SIPs directly in stocks to build long-term wealth the smart way. First, we will start with how to pick the right sectors for SIPs because your stocks are only as strong as the sector behind them. Then I'll show you how to identify SIP worthy stocks, companies with solid fundamentals that you can trust month after month. After that, a quick but important section on what to avoid, followed by some examples of SIP friendly companies, real names that show you what strong fundamental actually looks like. And finally, I'll break down the next steps so you can start taking action right after watching. So what's our goal here? It is to build wealth steadily using SIPs directly in quality stocks. This means investing regularly in fundamentally strong companies with long-term potential. Without further ado, let's dive in. Now let us take a moment to understand the obvious question. If mutual funds are already offering SIPs, why even bother doing SIP in individual stocks? The answer is simple: control, transparency, and long-term potential. So when you invest through mutual funds, you are trusting a fund manager to pick stocks for you. But you don't always know what they are buying, when they are selling, or how much they are charging in hidden fees. With stock SIPs, you are the decision maker. You pick the companies you believe in, you own those exact shares directly, and you don't pay management fees, exit loads, or trail commissions. If you want to invest only in clean balance sheet companies or high dividend payers or India's top banks and FMCG leaders, you can do all that in your own way. And here's the best part. In the long run, if you stick to quality companies, your stock SIP returns can easily beat average mutual fund returns, simply because you are cutting out costs and investing with intention. Yes, mutual funds are great for passive investors, but if you want to take a little more control and actually understand where your money is going, SIP in stocks is a smarter move. Before picking individual stocks, the first and most important step is to choose the right sector. Why? Because even a great company will struggle if the entire sector is going through a tough time. On the other hand, an average company in a booming sector often performs surprisingly well. So instead of starting with stocks, let us start with sectors. Let us think of areas where demand is steady. No matter what's happening in the economy, the demand is going to be strong. For example, FMCG, because people will always buy essentials. Pharma and healthcare, because healthcare is a constant need. Banking, because money is always going to move. So these are sectors that tend to do well over time. Also think of sectors which will grow as India grows. For example, infrastructure. With cities and roads expanding, it's going to grow. Technology. As digital becomes part of our daily life, growth prospects will be brighter. Finance. As more and more people join the formal economy, the demand is going to be strong. So when a sector grows with the country, your investments grow too. Some sectors get an extra push because of consistent policy support, like the renewable energy, the insurance sector, and the electric vehicle sector. So when the government backs a sector, the chances of growth often improve. Another key filter: stick with companies that lead their industries. These businesses typically have strong pricing power, high return on capital employed, and consistent earnings. That is what makes them reliable for long-term SIPs. They don't just survive in the market, they dominate it. So when you are putting your money regularly, you want that money behind a company that's already proven itself and not still trying to find its footing. It is always helpful to see where experienced investors are investing. If you notice strong interest in a particular sector from professionals or institutional investors, it could be worth exploring. But remember, just don't follow the trend. Follow what you understand and what you believe in. Let us switch gears and talk about the exciting part: picking the right stocks for your SIP. So how do you know if a stock is actually SIP worthy? We keep it simple with just two key checkpoints. First, is the business strong? Second, is the investment attractive right now? Let us unpack each of these. Talking of business quality and fundamentals, start with the foundation, the quality of the business. So here's a quick checklist to help you judge it. Ask yourself, does it have a proven, stable business model? It should not be some risky new idea. Is there a moat, something that gives it an edge over competitors? Are revenues and profits growing steadily year after year? Check return ratios. ROE and ROCE should ideally be above 15%. That means it is using capital efficiently. Free cash flow should be positive and growing. This shows the company is generating real money. Debt should be low. A debt to equity ratio under 0.5 is a good benchmark. And finally, is the company consistently growing its EPS and paying dividends? Now that usually signals strong management and financial discipline. So talking of investment attractiveness and market indicators, here's what to look at next. Valuation matters. Is the P ratio reasonable? Is the PEG ratio aligned with the company's growth? Check who's holding the stock. If promoters and institutions are staying invested, that is a positive sign. Large cap and mid cap stocks are safer bets for SIPs. They tend to be more stable. And here's a big one. How has the company handled market crashes? If it holds up well in tough times, that is a great sign for the long run. So we have talked about where to invest. Now let us flip that and talk about what to stay away from. Here are a few common traps that most of us often fall into, and trust me, they can mess up your SIP journey real quick. First, avoid highly cyclical sectors. Some sectors move in sharp cycles. They boom for a while and then crash. For example, metals, airlines, real estate. Now, unless we understand these cycles very well, it is better to stay away from such sectors. Now, these are the sectors which don't move steadily. They go through big ups and downs. They boom when the economy is doing well, and crash when the conditions get worse. So such sectors are the cyclical sectors. For example, let us compare the FMCG and the metals. FMCG, or the fast moving consumer goods, includes things we use in our daily lives like soap, toothpaste, food items, etc. So this sector grows steadily. The demand doesn't swing wildly, so the returns are smoother and more reliable. Now let us take metals, which comprises of steel, aluminium, copper, etc. So prices here swing sharply depending on global demand, commodity prices, and large infrastructure projects. So this means big jumps during good times, but also big crashes when the demand slows down. So if we see the data from the past 10 years, we can see Nifty FMCG index has delivered consistent growth even during market downturns. In contrast, the Nifty Metal Index has been a roller coaster, shooting up 30% in some years and falling sharply in others. So if you are doing an SIP in a steady sector like FMCG or pharma, you will face fewer shocks and your investment will grow more gradually and predictably. But if you do a stock SIP in cyclical sector like metals or real estate, you might make big returns, but only if you time it right. And let us be honest, timing the market isn't easy. If you get it wrong, your SIP could face long periods of negative or poor returns. So the bottom line, if you're starting with stock SIPs, start with stable sectors. Let your money grow quietly. Cyclical sectors, leave them for later when you are more experienced and ready to handle the ride. Second, skip turnaround stories or penny stocks. They may look cheap or exciting, but most of them lack strong fundamentals and end up draining up your capital instead of growing it. Also, stay away from companies with poor corporate governance or inconsistent financials. If the numbers look messy or the leadership keeps changing, it is a red flag. And finally, don't get lured in by hype. especially in the tech space. If a company has no profits, no proven model, and only headlines, hit pause. SIPs need stability, not speculation. Whenever you are investing, protecting your capital is rule number one, because money earned with your sweat should never slip into the red. Rule number two, be patient, because real wealth shows up when you give quality time to compounding. That being said, here are some examples of stocks that many investors trust for SIPs. In the FMCG sector, we have Hindustan Unilever, Nestle India, Dabur. In banking, HDFC Bank, Kotak Mahindra Bank, and ICICI Bank. Infosys, TCS, and HCL Tech from the IT services, Sun Pharma, Cipla, Dr. Reddy's from the pharma sector, and in insurance, HDFC Life, ICICI Lombard. Now, these companies have strong fundamentals, a history of performance, and kind of stability you want when you are investing month after month. These are companies with strong fundamentals and long-term track records. Now that you know what to look for in a stock and a sector, let's quickly run through your next steps to actually get you started with your SIP journey. Step 1. Finalize sector exposure. Begin by deciding which sectors you want to focus on. Choose a mix of stable and growing sectors like FMCG, pharma, insurance, or banking, depending on your risk profile. Step 2. Choose SIP amount and frequency. Decide how much you want to invest in each stock and how often. Monthly or fortnightly are the most common frequencies. Keep it consistent, and remember, even small amounts can add up over time. Step 3. Use a reliable platform. Pick a trustworthy platform or a broker that supports stock SIPs. Make sure that the platform lets you automate your SIPs easily. Step 4. Track key metrics periodically. Don't just set it and forget it. Every quarter or so, track your stocks. Keep an eye on things like revenue growth, profits, and any major business updates. Step 5. Review and rebalance. Once a year, take a step back, see what's working and what's not. Rebalance your SIPs, add to the winners, and let go of underperformers or sectors that no longer make sense. So following these 5 simple steps will turn your SIPs from a blind bet into a smart, systematic investment strategy. It's not about just buying stocks, it's about building wealth with clarity and discipline. To help you find good stocks, there are a plethora of tools available. Some of them are free and some of them are paid versions. Also, platforms of popular brokerages can be used. Let us talk about the free tools first. Screener.in is a great tool for checking financials and running your own filters. Money Control is perfect for quick stock reviews, news, and watch lists. Platforms like investing.com, NSE India, and BSE give you official filings and peer comparisons all at zero cost. Now, if you hold a Demat account with brokers like ICICI Direct, Sharekhan, Motilal Oswal, and a range of others also, they offer built-in tools and curated stock screeners, analyst ratings, research reports, and sometimes model portfolios. All are accessible within their platforms. So it is convenient because you can research and invest all in one place. Then there are premium tools which offer certain features as free features and certain features as premium features, like ticker tape, trendline, or simply Wall Street. These give you deeper analysis like fair value estimates, stock scores, or technical signals. But some features are behind a paywall. So here's the bottom line. If you are just starting out or doing long-term SIPs, the free tools plus your broker's research access are more than enough. But if you want deeper insights or active trading features, a premium tool might be worth it. So these tools can help you find quality stocks that fit your SIP plan. Final thoughts. SIPs and stocks can be a powerful way to grow your wealth, but only if you're picking the right businesses and the right sectors. So stay disciplined, invest regularly, and avoid unnecessary risk. Let your money grow steadily and the smart way. If you have a question or want to deep dive into any stock, please drop a comment below. Thanks for watching and happy investing.